Okay, so very good afternoon, everyone.
Good afternoon, Suganya.
Good afternoon, Sukanya.
Okay, so first of all, thank you for joining here for the session. So this is an 1 hour session. Maybe we'll complete by 4-5. So obviously, everyone will be assigned and engaged with a lot of work, but still spending a few minutes time for this would be like helpful for each one of us. And I would like to thank Bhushan sir for coming up with this topic. So I would like Bhushan sir, I request him to start with the session.
Okay, thank you, Sukanya. And first of all, thanks to Krishnan sir for giving me this opportunity. Uh, are you all able to clearly hear me?
Yes, sir.
Yes, sir, your audio is clear.
Okay.
Yes, sir. Yes, sir.
Uh, okay. So thanks to Krishnan sir for giving me this opportunity to share whatever little knowledge I have gained during my investing journey. And thanks to you, Sukanya, for taking a lot of efforts to organize this, following it up all those weeks, last 2-3 weeks. Mm, the topic, as you can see here, is investment and value investing. Now, I'm not very sure of the level of financial awareness of the audience that we have today. Though I have a lot of slides and I have I can get into details and nitty-gritties. The important idea, I think, should be uh, to know about what an investment is, why one needs to make an investment, and what all the virtues or the mm, things required to be a successful investor. And then we will come to value investing, which of course is a uh, is a part of investing, or it's a term which is given by Benjamin Graham for investing into stocks following a certain process. So let's start. I'll go through this agenda introduction. I'll briefly touch upon retirement planning and investment avenues, because though most of the people know about these things, at times people don't understand or don't realize the importance, especially of retirement planning, and what all investment avenues are available to an investor to invest in. So. Uh, every person aspires to be wealthy, healthy, successful, and happy. Now, for every person, the priorities could be different. These don't necessarily come in the order which I have quoted them, like wealthy, healthy. Everyone wants to be wealthy, and everyone wants to be successful. Happiness, of course, comes from within. Money doesn't buy you happiness. Money doesn't necessarily make you happy, but lack of money can make you, miserable. And of course, healthy. If you are healthy, you can enjoy all those things. If you're not healthy, all that wealth and success and happiness will never come to you. Now, it is important mm, to see how much time we devote for being wealthy, healthy, successful. Uh, if you look within, you'll realize that you'll see that each one of us during the active life, active earning life rather, whether it be job or business or whatever you do for a living, uh, you devote 90% of time to get money and to run after success to some extent. Very few people, devote time to be healthy. The body is a wonderful machine which the God has given us, but it needs maintenance and it needs certain precautions to keep it in good condition. And on it depends on the total success of our life, the happiness, the wealth, each and everything. I mean, all those things are just wasted if one is not healthy. But unfortunately, very few people, devote time or invest time in, remaining healthy, keeping good habits, eating good food, exercising well on a daily basis, at least 5 days a week. So that is one thing which I would like to, emphasize first, that the amount of time one, uh, one devotes to other things, it's all right. It is because you have responsibilities in life, you have family, you have to bring them up and all that. But still, for health, for exercise, for health related other things, one must take out time and uh, and be healthy in his life. So the priorities here should be, one should be healthy first, then one should be happy with whatever he gets, and then one should become try to become wealthy and successful. Those are the priorities I believe should be adopted by each and every person. Now, what are the most important qualities? In my opinion, these are the self-discipline and focus. Focus is something, very, very important. If you want to desperately get something, if you're dying to get something in life, you will definitely strive very, very hard for that, and you will be focused. You'll be focused on that goal all the time. So, focus on your goal is something very, very important. And if one has focus, if you have read the book Alchemist by Paulo Coelho, he says in that book that if one has the burning desire for something, the whole universe conspires to help him achieve those goals. So the conditions do change automatically to help you achieve your goals if you are focused within yourself. And second is the self discipline. Focus is one thing, but one has to strive, one has to, constantly try for that, and for that self discipline is required, be it enhancing your skill sets in the job, or getting ahead of other people, your competitors in a business, or acquiring skills in things in streams or in disciplines other than what your working discipline is. You need to devote time, and you need to devote time on a daily basis. And self discipline is absolutely important for that. You need to get up early, you need to have your uh, exercise, you need to read, you need to be in time for your job, and all those things. So once you make a habit of doing all those things on a regular basis, you are automatically tuned to achieve success, be wealthy, healthy, successful, and everything. This is the my philosophy of life. Um, Most of the people, I hope, would agree with it. Now, retirement planning. Retirement planning is something which needs to be, which needs to be the retirement has to be planned as early as possible in life. When you get into a job, at that time itself, you need to know when you want to retire. Not necessarily the age or something, but you need to know how much you would need in life, what exactly you would like to do in your life. And the goals will keep on changing. The money quantity or the success that you are trying to achieve, all those things are dynamic, those will keep changing, but you have to have some plan in place. And the plan has to be a dynamic one. It will change, it will keep changing all the time, but having a plan is place in place is very, very important. The next slide is especially I have designed it for the young ones. Many of you are young, and to become wealthy, you need to not only earn money, you need to save. You need to save, and then what your savings you have set aside, you need to see to it that the money is working for you to earn more money, and at a very good rate. Now, this is a power. This is what you call power of compounding. If you have a runway of say 5 years, 15 years, 25 years, 30 years, your wealth can compound to an extent which you will not believe today. It can make you very, very wealthy, and quite in quite few number of years, say 10 years or 15 years, depending on how your money that you have saved is working for you to earn more money. Now, here is a statistics. Uh, if you have heard of Peter Lynch was a American value investor. um, from the same school as Benjamin Graham's Warren Buffett and Charlie Munger and all these people. He ran a fund which was called Magellan Fund, and between 1974 to 1989, 15 years, he gave a compounded return of 29%. This is something highest in the annals of investing world. So if your money is compounding at 29% every year, in 5 years, 1 lakh can become 3.5. In 15 years, it will be 45, and in 25 years, it will be 581. Some This wealth is, untold wealth, in fact. But normally you won't get. Warren Buffett now still investing. He has been in the investing field, but in the value investing for close to 70 years now. He with Charlie Munger. They run the mm, uh, Berkshire Hathaway. He has been able to return some 21%. Now, let's come down to the Indian scenario. Most of the mutual funds, especially the index funds, if you study them well, and if you invest on a regular basis through market cycles, you should be able to get 14 to 15%, which is good enough. 14 to 15%. You know, uh, I would very strongly recommend all of you to download or to visit a site which is called calculator.net, and there is a CAGR calculator there, which will give you the amount at a certain percentage of return compounded every year, how much it will become after a few years. And that it's very important to have that idea in mind, that how the money multiplies over the years. So Indian mutual funds can give about 14 to 15%. Real estate maximum can give you 12%. That too, if the appreciation is good in cities like Mumbai or Pune or Bangalore, Kolkata, like that. But in the smaller cities, it won't give you even 7, 8%. The and it's highly illiquid. The real estate is highly illiquid. I'll come to real estate later on. FDs will give you maximum 8%, and gold has given in the last 30 years about 9%. Gold is something which is termed as an insurance against black swan events. You know what black swan events are, which are the events which are completely unexpected. For example, COVID. When COVID struck and the lockdown was announced, incidentally, on 26th of March 2020, 22nd March it was announced. 26th March 2020, my son was supposed to get married, and that was, of course, everything was put off. At that time, everybody thought, I too thought that it will be 15 days and we'll have another date and we'll have the marriage. Uh, Nobody imagined that that things could turn so grave, and we'll have this total impact for more than 2.5 years. Nobody imagined. So that was a black swan event, something like a big war, something like a big earthquake, or in your area, or things which you can't predict, and which have profound impact on everything uh, that surrounds you. Those are called black swan events. And if you look at history, in every during every such event, gold shoots up. Gold shot up from about 48,000 to now 58, 60,000 per 10 grams during after COVID. Before COVID, it was something around 48, 49. So every such incident pushes gold to higher levels. Now, this is the power of compounding. Now, I already talked about the discipline and focus. So, if you want to become wealthy, you must set aside, at least as a thumb rule, 20% of your income, and invest that income into uh, some avenues, some investment avenues which suit you, which you can understand, and uh, try to multiply your money as you go ahead, progress in life. So, at the end of, if you say I have 15 or 20 years of active life or 30 years of active life, such an approach is likely to make you wealthy at the age of 40 or 45 itself. And then you can choose. You have a lot of things to choose from. and what to do, or you may have some other things which you could not pursue because of the pressures of earning for the family. All those things you can or you can just travel around the world. Money can do a lot of things for you. So to become wealthy, a systematic approach, an approach which is with focus and which is with discipline is very, very important. So let us move to what retirement planning is. Uh, as I said, one should do it as early as possible, but most of the people don't do it. Even I didn't do it. I lost I was working in an Australian company in 2015, and there was that time it was oil price crash. I was laid off. I thought I'll get a job. I had a lot of experience. I had a lot of knowledge. So I thought I'll get a job in 6 months. But I didn't. And that time it struck me that it is possible at the age of 52, I may have to retire. And I was forced into planning for retirement. And in fact, I wrote a blog, my first blog, second blog on retirement planning. It's very important. It didn't strike me all those years, and it won't strike you, because if you are earning well and you are spending well and everything is going nicely, you will not realize. Uh, but when something untoward strikes you, that time you realize this thing. So better to be, cautious upfront. For retirement planning, I have written a blog. You can go through the blog. It's very simple. You have to just calculate your expenses. What I did is I downloaded an app and uploaded every expense above 10 rupees in that app for a period of 6 months. So at the end of 6 months, I got a fairly good idea of how much I am spending per year. And providing for inflation, I deployed all my funds. So I would get that much amount yearly, which will feed me and my family and take care of my mm, liabilities. So that is about retirement planning. Um, this details in my blog. There is even an Excel sheet which you can refer to if you want to. Not if you want to. I think you should. Now, investment avenues. There are a lot of things wherein you can invest, and they fall into different categories. The first is fixed income assets. In this, you have RBI bonds, PPA, postal deposit scheme, bank FDs, company FDs, non-convertible debentures, debt funds. These are all these all will give you fixed income per month or quarter or year, and generally, depending on the type of instrument, your capital is not at risk, especially if it is PPF and postal deposits and RBI bonds and FDs of standard banks like nationalized banks, SBI, and even HDFC, ICICI. Those banks are not going to go down. So your capital is safe. But when you come to NCDs of companies or debt funds, there is some risk involved. Uh, Even the small cooperative banks, there are a lot of cooperative banks that go down. The managements are at times shady. They have vested interests, and they take the banks down with them. So these are the fixed income assets. Then you have mutual funds. Mutual funds are basically funds which invest again in the stock market. So in the stock market, there is wealth creation. Like suppose you have a company like HDFC. In 2003, HDFC income was hardly anything, but today it's a big bank. Same with ICICI, same with Axis Bank, same with Titan Company, same with so many frontline companies. They were all small companies at time, and with just about 50 crores, 100 crores of net profit per year. Now they're TCS, for example, Infosys. They're all earning in thousands of crores now. So this is basically the wealth creation. They have grown their business, and every year they have been increasing their profits. And by buying those shares, you are participating in that wealth creation. Fortunately, now Indian economy is just booming. India are in a very sweet spot compared to a lot many other nations because of China one factor also. China one factor is basically what a lot of countries are not preferring China to depend only on China for their supply chains. If you heard of the chips shortage some time back, and the passenger vehicles were not available for a year, or even waiting periods were so long. So all those things were coming from China. But now the big companies are having second thoughts on only having only China as their supply base, and they are diversifying into other countries where, in case there is a problem with China, they can always keep their supply chains intact. And India is one of the big beneficiaries. So, like Rakesh Jhunjhunwala, I too believe in the good growth of Indian economy, and the coming years are going to be very, very good for Indian corporates. There'll be there'll be good profits for those, and there'll be a lot of wealth creation, which we can participate into by buying stocks, which are fundamentally good. So that is stocks. Real estate. Now a lot of people a lot of people believe in real estate, but basically in India you have the rental income. Like if you buy a flat, say, of value 1 crore, you'll not get more than 20,000 or 30,000, not more than 2 to 3% rental income. And then there are taxes and maintenance and all that. And if you are in a big the flat or your asset is in a big city, then it will appreciate well. But again, it is illiquid. When you sell it, you may not get that price. So it doesn't make sense here, in India at least, to invest your money in real estate. In other countries like in UK and in Europe, even in US, things are like slightly different. They have higher rental incomes, 6 to 8%, 7% rental income, and good appreciation as well. So there people do invest in real estate. In fact, but here in India, it doesn't make sense to invest in real estate. I personally don't recommend. In fact, I would go to the extent of saying that it makes sense not to own even one house. If just for example, buying a 1 crore rupees flat and saving 20, 30,000 or 2 to 3% of your that 1 crore, uh, 2 to 3% is 2 to 3 lakhs per annum of that 1 crore doesn't make sense. Rather, you pay the rent, you stay in a rented flat, and sorry, yeah, you pay the rent, stay in a rented flat, and invest that money, if you have that money, into better asset classes like stocks, which will give you at least 10 to 15%. That will multiply your money much faster. But most of the people won't subscribe to that, and it's not practical at times, because there's a lot of hassles in changing the accommodation all the time. So one accommodation, one own accommodation, everybody goes for, and one should not have more than one. Then gold and precious metals, as I said, it's an insurance against inflation, and it's insurance against black swan events. It's real money. It's Gold is still considered real money because it has withstood the test of time. From millions of years, gold is there as considered as real money, and it has not lost its value. The sixth is painting and antique value assets. These are not for us. Uh, these are basically for ultra rich people, but they do invest in China. I mean, the bone China and very old, that Ming dynasty, what they call it. And last is cryptocurrencies. Again, this is a lot of people have started investing, but let me tell you, this is just a supply and demand phenomena. Cryptocurrency, like a company or like a stock of a company, it has no value creation. It does not create value. There's no business which is earning extra money through the business, and you are getting the returns, or you're participating in that wealth creation. It's just if there is more demand, it will the price will go up. So, and then there are going to be a lot of regulations. It's mainly a speculative asset, if you call it an asset. Um, my suggestion is never go for this. So this is about the investment avenues what you have. Now, mutual funds. Uh, Mutual funds are the is a investment avenue that is of late catching up a lot. And basically, the mutual funds again invest into stocks where they participate in the wealth creation, and some good, if you have good knowledge, uh, and if you can monitor at least once in 6 months or once in a year, which and you don't have time and energy to study and invest into stocks directly, then mutual fund is the way for you. So just park your money into mutual funds. You will get 12%, 13%, 15%, which is way high, way above um, the FDs or bank FDs or NCDs, anything. And if you have a good number of years with you, then the compounding will do the rest. But again, the discipline is important, and saving 20% of your active income is important. Now, lot of mutual funds are available. There are sectoral mutual funds. There are large cap mutual funds, small caps mutual funds. Large caps are big companies with high market cap, high uh, what you call market cap. If you understand what market cap is, it's number of shares into the price of shares, price of a single share. So large caps are the companies which are basically participating into the Sensex. They form the Sensex. There are 30 companies. The Sensex or the Nifty, the movement of that, it depends on the individual movement in those 30 shares or 50 shares participate, which are part of that group. Then there are small cap companies which are very small companies, but they are growing very, very fast. And some of them might graduate to the mid cap level, say 20,000 crores market cap, or even some of them can become large caps. And if you own, say, 10 small companies and even one or two become, do well to become large caps, then you have a jackpot. But then again, for that, a lot of knowledge is required, and a lot of patience is also required. Now, for mutual funds, SIP is the best route, because then you go through the cycles. You had a down cycle during COVID, so that time, if you had an SIP going, you would have purchased a lot of units of mutual funds at very low cost. So consequently, when the market went up, you purchased at high cost. So it got off sort of averaged out. So mutual funds is the avenue for investment for people who don't have energy, who don't have inclination to study individual stocks and invest into individual stocks. Though, of course, the individual stocks, if studied well and bought at a good value, can give you returns far, far better than mutual funds. For example, I'll tell you about a few companies that I own. Tata Elxsi is a company which is into the design of electronics, and it supports a lot of other Tata companies. This company was available at a price of 700 rupees in March 2020, and it has gone more than 7,500 now. Company is doing extremely well, and the value is the price is 10 times. And there are so many good companies like Tata Elxsi. You have Persistent, you have Sonata Software, you have Cosmo First. You have so many companies which are really, really doing well, and they have the tailwinds of growing Indian economy. The exports are growing. The Indian clout in the market, in the international market, is growing, and there are all the positive factors playing for growth of Indian economy, and consequently growth of the Indian corporates. So this and the last 1 or 2 years, last 5 years, in fact, has been the prime time or the golden time for investment in Indian stocks. And you can see that from the foreign institutions investment, which is coming to India now. There were times when the foreign institutional investors used to invest only for a few months and then take their money away. They do that still to some extent, but it doesn't affect the market any longer, because more and more retail investors, more and more mutual funds are coming into the market. We have very few, I mean, compared to the developed countries, very few people still invest in Indian stocks, the Indians, the retail investors. And but the number is growing. The number is growing geometrically, and uh, in a few years, stocks will be really, really, overvalued, or it will those will be costly. Uh, if you know what the valuation will be coming to that, but will be costly than what they are now. So this is the time. Uh, the next slide is the value investing. Value investing is a part of it is a branch of investment. It is called fundamental. There are two approaches, uh, which is called one is called technical analysis and second is called fundamental analysis. Technical analysis, if you have heard about it, is about the people who do intraday, the people who do F&O, the people who invest for short term. They make charts. It's all statistical. From the price movement, they predict where the price of the share will go down and up, and within that limited time frame, they buy or sell and earn their money. Of course, they don't participate in the long-term wealth creation of a company. They generally don't have anything to do with what the company does, what is its business, what are its financials, whether it is whether the valuations are good, is it undervalued or overvalued. They have no concern about all these things. They only see the price. So that is one approach. But really, these short-term investors don't participate in the long-term wealth creation of a company, and consequently, they invest a lot of time. They are on in front of the terminals from 9:15 in the morning to 3:30 in the evening. They earn a few thousand. And the SEBI report, SEBI published a report last year that 90% of such people lose money. Now, when there is no long-term wealth creation, it's a zero-sum game. So if you are earning something, someone else is losing. And when 90% people are losing overall in a year, you have to be in that smarter 10% bracket, which is very, very difficult, and which is almost next to impossible to be in that bracket for a long, long time. So I certainly don't fall into that category, and I don't think many people do fall. And I would very much advise you very much against going into that. Steady value investing, which is basically the long-term wealth creation, and then if you can't do that, then just invest in good mutual funds, and you are good. Uh, Now let's see what. Sukanya, we have how much time?
So we planned it for an 1 hour session. So we started at 3:05. So maybe by 4:05 we have to stop, sir.
Okay, okay.
So you need
Right.
extra time?
No, it's okay. I mean, I'll not go into the very detail. I'm just trying to explain the need and how one can, participate in the long-term wealth creation of the Indian corporates, and
Okay.
what are the qualities required for that. And value investing now, which I am coming to, is the best, avenue or the best way uh, to get to that goal. Now, this
Okay.
was a process developed by Benjamin Graham. If you have heard him, he was there in early 19th century, and he was guru of Warren Buffett. Warren Buffett, of course, all of you must have heard of about Warren Buffett and Charlie Munger are they are in their 90s now, and they run a company called Berkshire Hathaway, which owns many other companies and stakes in a lot many other companies, and they have successfully implemented this model. They have written a lot of books on that, and all our big Indian investors, if you know Rakesh Jhunjhunwala, then Dolly Khanna, then Monish Pabrai, Pauline Tu, all these people have made a lot of wealth, 1,000 crores, 2,000 crores, 5,000 crores, and they are all fans of Warren Buffett and Charlie Munger. It doesn't mean that you have to be big to follow this process. The process is basically very, very simple. What it says is uh, you buy fundamentally strong stocks. Now, what is fundamentally strong? Fundamentally strong is where the business is very good. The business, if you understand the business, and if you feel that this business has got growth potential, it is going to be there for the next 10 or 15 years in your foreseeable future. It is generating some good profits, say 10 15 percent of its revenue, and the profit is going up every year. Everything is then there are three aspects to study a company. First is business, second is fundamentals, and third is valuations. Now, they say once you identify a business which is fundamentally strong, you buy that business when it is quoting at a discount to its intrinsic value. Now, this is where it gets a little complicated. Mm, Let me explain the idea of intrinsic value by giving an example, or rather a valuation example. You go to the market to buy a TV. You want to buy a TV which has got certain, which should have a certain, it should be a smart TV, then picture should be good, sound should be good. You have certain criteria, and you go through the TVs available in the market, and then you see you have two TVs which are satisfying your criteria. One is Samsung, another is Sony. Now you evaluate. Samsung is available at say 60,000 rupees or 50,000 rupees. Sony is available at 70,000 rupees, maybe 10,000 or 20,000 higher price. Then you evaluate uh, whether the both are meeting your criteria, and whether the Sony TV, which is quoting at 20,000 extra than Samsung TV, are the features that much better compared to a Samsung TV. You evaluate whether there is value. If you understand now what the difference between value and price, the prices are known. The price is 70,000 and 50,000, but value is something which is not quantitative; it's qualitative. You have to evaluate yourself that whether this is worth, this has got this much value, and if you feel that 70,000 Sony TV has that value, you may buy it. The same principle goes for stocks. You have to evaluate. I mean, the value investing technique evaluates those stocks for their intrinsic value. How much the if a certain, now the example I gave you of Tata Elxsi. Tata Elxsi was quoting at 700 rupees, and now it is quoting at 7,500 rupees. Now, whether Tata Elxsi has got potential to return at 12, 13, 15% at this 7,500 price, you need to evaluate that. And if I mean, from 750, when it was quoting at 750 rupees, it has definitely grown its profits and everything multifold, and that is why the market is giving it such a big 10 times price. But then, is it really worth at this price? This evaluation is called intrinsic value calculation. It is as much quantitative as much qualitative. And for evaluating the qualitative part, you need to have experience. You need to first study a lot about the company, what the business is, how the business is running, what the management is, what are the profits, lot many things. I mean, it's not a light hearted decision. Once you evaluate the company, you like the business, then only you look at the financials, the past history and valuations. Then you look at whether this is worth for 7,500 rupees, or you should wait for some down cycle to let it come down to say 3,000 or 4,000 rupees, and that will be the correct valuation for that stock. So the idea is to evaluate a business or a company or a stock for its intrinsic value, and then wait till the price, the market quote, drops below that intrinsic price. There has to be a significant discount to that intrinsic price. At least people like Warren Buffett, Charlie Munger say it should be at least 30%. Means an asset is something you are going to the market to buy. It is available at 30% discount to what its price should be. Then you buy it. and then you just wait. Then you just keep it with you and wait for the market, because market goes through the cycles of greed and fear. The COVID was a cycle of fear. Everybody was fearful. Everybody thought the market is going to crash, and every all the businesses will collapse, and they were all selling, and very good companies were available at knockdown prices at that time. So that was a fear cycle. Then the cycle turned. People after COVID, I mean, the effect of COVID went down, and businesses started recovering. Market is always forward looking. Everybody started buying stocks, and currently the stocks are quoting at very high values. It is called market euphoria. So Michael, market always, you know, goes through these cycles of greed and fear. One such cycle was in 2008. If you remember the Lehman Brothers crisis, Lehman Brothers the crisis. Uh, Before that, there was a dot-com bubble in year 2000. So every 7 8 years, such an incident will happen, and by that time, you for taking advantage of such cycles, you have to develop a skill of uh, calculating the intrinsic values of the stocks, and when they quote at a discount to their intrinsic value, buy them, sit over them for a few years, and then when the market rates them too highly, just sell them and make your profit. This is this is what is called value investing, and this is what is practiced by most of the top-notch, investors in the world, also in India. But it's not as simple as it sounds. It does take a lot of effort to evaluate those companies. So the important ability is to differentiate between price and value, and to have the guts to take advantage when the market is collapsing. You should be ready to buy. So lot many people won't have that temperament. Temperament is something very important in stock market. In fact, there's a quote by Warren Buffett. He says, if you can't see your portfolio going down by 50%, you should not be in stock markets. And that is what exactly happened during COVID. Everyone's portfolio went down 50%. Every day there were losses from starting from 18th of March, if I remember correctly, till end of mid April, and then it stabilized. So uh, to take advantage of those cycles of greed and fear, and those things do happen, keep happening all the time. So market does give you chance. Some share which is quoting at very high price today, market will definitely in a year or two give you a chance to buy it at a lower price and to sell it at even higher price, maybe 4 years down the line. So those opportunities will be available. You should be able to identify those stocks, evaluate those stocks, which again is a skill, which again is as much art as science, and one has to learn. I have been investing in stock market say like last 20 years, but I have learned very few things only during last 4 5 years. Before that, it was pathetic. I mean, it was like uh, fighting with a saber in the dark. I didn't know what I was doing, frankly. And this happens with everyone. But once you know someone who can guide you, and once you start, doing things yourself, things do fall in line. So this is what value investing is all about. Now, this we already talked about intrinsic value. Uh, how you calculate there are methods like discounted cash flow. If you are conversant about the term NPV, net present value. Net present value is the value of money value of money today that you'll be getting in future. For example, if you are going to get 100 rupees say next year, today its value is not 100 rupees, it's less, because if you get it today, you'll get 8% interest on that. So that will become 108 rupees next year. So consequently, the value of 100 rupees that you are going to get next year should be around 92 rupees only this year. So that way you calculate the future profits of a company, you discount them for the period that when you are getting them, and arrive at what the company is worth today. And this is basically a formula which is called a discounted cash flow formula. And then there are a lot of other factors you need to uh, put in to get get that figure right. So that is value investing for you. There's a 60/30. If some of you are conversant with financials and valuations, then there is a 60/30/10 principle, which says the when you are shortlisting some company or stock for buying, the first thing to see is the business, which is most important. If the business is good, then you move forward and look at its financials. Financials are how much company is earning, how much profits it's going, how much its net profit margin, how much is its debt, how much is the growth in its revenue and profits, whether any financial institutions own this share, how is the management, how focused is the management, how transparent is the management. You might remember the Satyam case. They fudged their accounts for years, and then when the bubble burst, everybody lost their money. So this keeps happening with companies every now and then. But there are ways and means to go through the, like, we are not financial people, most of us are not. CAs and those people have better means to uh, you know look at factors where companies can be hiding facts or manipulating accounts. But at the same time, we can learn those. There are books available, there are guidelines available where you can see and where you can judge for yourself whether to invest in such a company or not. Because there are 5,000 companies in stock market, and you are going to invest in only a few companies. So you have to find reasons to reject. Just go on rejecting companies, and you will find a company which is good in all respects, and that does happen with everyone. Uh, Here are some very interesting quotes. Um, in fact, these are not quotes. These are the lifetime, knowledge sharing of these value investment grids. Uh, See the first one. In the short run, the market is a voting machine and not a weighing machine. So the market, as per supply and demand, will give higher price or lower price to a stock. But it does not market does not see what it is really worth. That intrinsic value market is not looking at, and that you need to look at and buy that asset at a lower price, or at a price which is at a discount to its true value. um, Again, the next, I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later one will. A business has to be so good that even a person at the helm of affairs uh, will not be able to do much harm to it. Uh, Very few people can spot such businesses, and Warren Buffett was one of them. And uh, see the fourth one. The stock market demands conviction as surely as it victimizes the unconvinced. What does it mean? Conviction. When the COVID came, the market crashed. All shares were quoting at rock bottom levels. If you had conviction, if one had conviction that time, these shares are good and they will bounce, one would have bought them. That is what conviction is. But a lot of people, sold those stocks, and later on when they bounced, there is always a price anchoring. If I sold a share, if I bought a share at 100 rupees, it goes to 200 rupees. It is equally good, and it is still worth 300 rupees. But my mind is anchored to that 100 rupees. I may not buy it. And that is what happened with a lot of people who sold their stocks during the COVID wave. They did not buy them back, and they lost the opportunity to participate in the rally that followed. So next, again, a few ones. Uh, Price is what you pay, and value is what you get. Warren Buffett again. So price and value investors do differentiate and do attach a lot of importance to what the share is quoting, which is the price, and what the share is worth, which is the value. And once a value investor starts, getting the value right, he becomes successful value investor. There are some more quotes. We have sort of time, but you can go through them. And I have a few more slides uh, here. What is the value investing process? You have financial analysis, you have valuation, you have risk analysis. Then your investment has to be staggered. It has to be distributed across sectors. Sectors are like, what sectors are: pharma sector, automobile sector, then construction sector, sugars. All these are different sectors, and there are a lot of companies, automobile, EV companies, electric vehicles, and there are banks, financial institutes. There are a lot of sectors, and every sector will have their ups and downs. So you need to have your investment across the sector so that it won't be concentrated in a sector, and if that sector is in disfavor, you will not lose much. Then monitoring is very important. Once you buy stocks, there are quarterly reports, there are annual reports, and there are all other types of reports which are available, which tell you about health of the company and the investment rationale which you had put forward while shortlisting the company for buying. You have to assure yourself that things are playing out as per that investment rationale, so that there is, you remain invested. And if there is something very untoward happening or bad happening with the company, it calls for course correction, and you may exit that company by some other company, and so on. So we do not have time for all these, but these are the nitty-gritties. These are the intricacies of business analysis. I told you a few things about what all things you need to see in the businesses. How you choose the business first, which is 60% weightage for your analysis. Then you go to the valuation, whether uh, then you go for the financial analysis, which is 30%, which basically gives you a track record of the company, how the company has been doing during the last 5 years or 10 years. Has it been increasing its profits? Has it been increasing its revenues and the top line? Has it reduced its debt, or is it debt free now? So all those things. What is the OPM, operating profit margin, net profit margin? Are they having the increasing trend, or they are stagnated? So all these things you see, and you attach 30% importance to it, and uh, go ahead to for valuations. Now valuations is the most important thing, whether the stock is worth that price. There's a factor called PE, price to earnings ratio. I'll give you a very simple example. You have a 100 rupees bank deposit. The bank deposit earns you 8 rupees, 8%, that is 8 rupees per annum. So what are your earnings? Your earnings are 8 rupees, and your price is 100 rupees. So price 100 divided by earnings 8, P by E, that ratio becomes 12.5. 12.5 for a bank deposit. So you will have a lot of companies in market which will have a P by E less than 12.5, more than 12.5, but 12.5 is an anchor figure which we can consider as reasonable. Again, that depends on whether how big is the company, which sector it is, what was his 5-year median for that P, and all those things. But one of the just to get an idea, it gives you how much earning the company is giving you compared to the price that you are paying for the company. So that is one of the most important factors. And if that factor is not in your favor, if the price is too high, despite the business being very good, despite financials being very good, you will not buy that company. You will wait for the valuations to ease, valuations to come to the level that you think are reasonable, and then and only then, because that is the first principle of value investing. Buy a good asset at a discount to its intrinsic value and sell when it is quoting at a premium. Simple. So you have again in the process of shortlisting, you have risk analysis. There are a lot of risk, regulatory risk, cyclicity risk, earning quality risk, transparency risk. There are promoter pledging. There are a lot of things one has to really see. I mean, it's not as easy as it sounds. But once you adopt the approach, and once to some extent master these things to some level, there are a lot of resources available for you to do that. And once you do that, there is, in my opinion, no other sure shot way to getting wealthy. And the longer runway you have, if you have good number of years with you and you go on investing on a regular basis, on a yearly basis, 20% of your savings, you can become really, really wealthy. For me, I started quite late. I started, though I was investing some amount for say 15 years. Bulk of my investment has come in last 5, 6 years. When really started realizing or understanding things, and it does happen. Not everything clicks to anyone first time. It takes time, but now, fortunately, a lot of resources are available. A lot of people are available who are good investors who can guide. I myself guide a lot of people. I have my college group. I have other groups, and I guide a lot of people. But my experience is that people don't want to invest on their own. People want to be spoon-fed, because the investment decisions are people don't want to own those decisions, because there could be losses, there could be gain. So they always want to. Even the mutual fund investors will have some agent. Agent will tell them something, and they will do accordingly, so that if there are losses, they can blame someone. Nobody in this is human tendency. Nobody wants to blame himself or be ready to own its own the decisions he take, especially the financial ones. But I would very much recommend you to be your own boss, to understand things, try to get to the root of the things, take help from all people, including me, if you wish, but own your decisions and be wealthy. That's my message. I think we are running short of time, and here is the summary. So
Sir,
stock
sir,
markets.
it's okay, sir. We can take extra 5 or 10 minutes, sir. You can please continue.
Okay.
Yeah.
So in my opinion, the stock markets, especially currently the stock markets in India, because as I said, India are in a very sweet spot currently. The economy is the fastest growing economy, and in next 2, 3 years, it will be uh, most of the corporates will be doing very good. So if your stock selection is good, if you invest, currently it's not the time to invest in stock because the markets are very high. In fact, I have myself encashed quite a bit of stocks, and I'm sitting on cash ready to be deployed when the markets crash. I'm waiting for a market crash. If it doesn't happen, let it be. But one has to stick to the process. When they are overvalued, sell them. When they are undervalued, buy them. Simple. So they became overvalued from March onwards. I sold at least 20% of my stocks, not all, but some portion of those stocks. Most of them I am holding still 80%, 90%, and I am sitting on cash. If the market when the market crashes, I'll buy. So that is the lesson of value investing, which I am trying to um, it so happens many times that a stock I sold goes up by 50 rupees next day, goes up by another 50 rupees next day. It has happened that the stock I sold at 700 rupees has gone to 1300 rupees. But then you cannot predict. You cannot predict the market, how the market will behave. No one has ever predicted market correctly. No one ever will, and one should not try even. So one has to have a process in place. Stick to the process. When you think the asset is overvalued, too much overvalued, 50% overvalued than its intrinsic value, just sell. And then don't cry over spilled milk. Whatever happens, happens. It market will surely give you an opportunity to buy it at 50% discount. In 2 years, in 3 years, in 5 years. Wait patiently. As Charlie Munger famously said, the real money is not in buying and selling. The real money is in waiting. And Charlie Munger and Warren Buffett, they say we spend hours, most of our time, 95% of our time in just reading. They sit and they read. They don't act. Acting is very, very rare for them. Of course, all those qualities, it is difficult when you see you have a sizable amount of portfolio, and then daily you see the market going up and down, and your portfolio losing value or gaining value. Uh, it's human tendency. You cannot remain, aloof from that. But I would very strongly recommend you to go through 14 lectures the late Parag Parikh delivered to for IIM Goa students. It talks about a lot of biases or the human what you call human biases and human mm, fallacies which come in the way of rational thinking, and rational thinking is something you need in stock markets. So there are a lot of resources available. These ones are really very, very good. There is Charlie Munger as well, but this Parag Parikh has explained it very, very well. Go through if you are a stock market investor, and do become a stock market investor if you are not an investor now. That's all I had to say. Thank you so much for patiently listening to me. I have a professor streak in me, and when I start talking, I keep talking. I'm sorry if it was a little boring for you, some of you. But the final message is, as long as you have time, be disciplined, be focused, set aside 20% of your earnings, invest in stock markets with in good stocks. First, learn what good stocks are, how they are to be identified, and then invest and go on investing. You will definitely become wealthy, and do invest a lot of time, at least a couple of hours daily for your health. That's it. Thank you so much.
Thank you, Bhushan,
Thank you very
sir,
much,
and
sir.
thank you everyone for joining. Actually, sir wanted to make it very elaborate, but due to the time constraint, he was just able to cover the basics. But still, thank you so much, sir, for your time. Maybe those who are interested to know more about stocks, maybe we can have another session in continuation to this. So maybe we'll check the response and we will decide on that. So once again, thank you, Bhushan, sir, and thank you everyone for your participation. Thank you. You,
Thanks
you
for the
guys have
opportunity,
any
Sukanya.
questions? Thank you, sir. And anyone like, would you like to ask something to Bhushan, sir? Any questions? Okay, so I think there is no questions
I
from
I
the
think
chat.
not many will have questions because the topic is a little bit heavy to understand
Huh.
in the first instance. And
Okay,
if they have questions and if they want any guidance, I'm available all the time. They can get in touch with me. And
that is
Sir,
really
how
this
nice.
sir,
value
how
invest,
can I contact you?
I have this. My email is available at AI4Bharat.
Okay, okay,
Uh,
okay, sir.
yeah. Uh, I think it's in my profile, so you can get in touch with me. And this value investing process I have written. In fact, I started writing blogs on value with the value investing process itself, and there are 7 of them in about 40 blogs I have written. First was on retirement planning, and another 7 was on were on value investing process. So if you are interested, visit the blog site is here, and you can have a feel of exactly how what it is. Here is my mm,
Email.
uh, blog email and blog site.
Okay, sir. Thank you very much.
So shall we call it a day, Sukanya? If there are no questions,
Yes, yes, sir, we can. Yeah. Thank you so much, sir.
thank you. Thanks
Thank you,
everyone.
everyone.
Thank you.
Thank you so much, sir.
Thank you. Thanks everyone.